Hello and welcome to our in-depth video on the Buffett Indicator. Today we will explain in detail what the Buffett Indicator is, how it is calculated, how to interpret it, and what historical examples show how effective it can be. At the end, we'll take a look at the criticisms and limitations of this indicator. So sit back and let's dive in. Right after the intro, we'll get right into it. Stay tuned.
Insights for the informed investor.
Before we start with the video, please note that this is not investment advice, and this is my personal research. What is the Buffett Indicator? The Buffett Indicator, named after the legendary investor Warren Buffett, is a measure often used to assess the valuation of stock markets. Buffett himself described this indicator as probably the best single metric to assess the state of a stock market. But what exactly is the Buffett Indicator, and how does it work? Definition and meaning. The Buffett Indicator measures the ratio of the total market capitalization of all listed companies in a country to the gross domestic product of that country. The idea behind it is simple. If the market capitalization is very high in relation to GDP, the stock market could be overvalued. If it is low, the market could be undervalued. Calculation of the Buffett Indicator. Let's go through the calculation in detail. Buffett Indicator equals total market capitalization divided by gross domestic product. To illustrate this, let's take the actual numbers I found. The total market capitalization of all listed companies in the U.S. is $54588 billion, and the gross domestic product of this country is $28629 billion. Then the calculation is $54588 billion divided by $28629 billion is equal 1.906 or 190.6%. This means that the total market capitalization is 191% of the gross domestic product. Interpretation of the Buffett Indicator. The Buffett Indicator helps us understand whether a stock market may be overvalued or undervalued. Here's how to interpret the results. Undervalued. A value below 100% could indicate that the stock market is undervalued in relation to the economy. Investors may see this as a buying opportunity. Fairly valued. A value around 100% is often considered fairly valued. This means that the market capitalization is proportionate to the economic performance. Overvalued. A value significantly above 100% could indicate that the stock market is overvalued in relation to the economy. This could be a warning signal for investors. Historical examples of overvaluations and undervaluations. To understand the usefulness of the Buffett Indicator, let's take a look at some historical examples. Dotcom Bubble, 2000. At the start of the new millennium, the stock market experienced an immense upward movement, particularly in the technology sector. The Buffett Indicator rose to over 150%, indicating a massive overvaluation. Many technology companies had huge valuations driven by speculative expectations of future growth, although they often generated little or no earnings. In 2000, the dot-com bubble burst and led to significant losses on stock markets worldwide. Financial crisis, 2008. Before the 2008 financial crisis, the Buffett Indicator was also at a high level and exceeded the 100% mark, indicating overvaluation. The real estate market in the USA was heavily overvalued, which ultimately led to a major financial crisis. After the markets collapsed, the Buffett Indicator fell as market capitalization plummeted and the economy went into recession. COVID-19 pandemic, 2020. The COVID-19 pandemic led to enormous economic uncertainty and a temporary slump on the stock markets. Despite these uncertainties and the economic downturn, the Buffett Indicator rose to over 200%, again raising concerns about possible overvaluation. However, the markets recovered faster than expected, supported by massive fiscal and monetary policy measures worldwide. This shows that while the Buffett Indicator is useful, it should always be viewed in the context of the current economic and political situation. Criticism of the Buffett Indicator. Although the Buffett Indicator can be a useful tool for market analysis, there are also points of criticism that should be taken into account. 1. Globalization of companies. Many large companies generate a significant portion of their revenues outside their home country. This can distort market capitalization relative to GDP, as GDP only measures the domestic economy. 2. Differences in capital structure. The Buffett Indicator does not take into account the capital structure of companies. Companies can be financed differently, with more or less debt, which affects market capitalization. 3. Interest rate environment. Low interest rates can drive up stock market valuations as investors search for yield. However, the Buffett Indicator does not directly take into account the current interest rate environment, which can limit its usefulness during periods of low interest rates. 4. Growth rates. Countries with different growth rates may have different Buffett Indicator scores, which do not necessarily indicate over or undervaluation. Conclusion. To summarize, the Buffett Indicator can be a valuable tool for evaluating stock markets in relation to the economy. It provides a quick overview and can help investors to identify potential over or undervaluations. However, it is important to consider this indicator in the context of other economic indicators and the current market situation. Thank you for watching. If you enjoyed this video, please give us a thumbs up and subscribe to our channel for more in-depth financial analysis and market assessments. Share your thoughts and questions in the comments below. We'd love to hear what you think.